All right, hello, welcome traders. Hey, it is September 25th, 2025, coming to you here after the markets closed today. Market was just off about a 0.5% today. Nothing big going on. Markets are all bullish. Things look pretty good. I want to share something today. It's a little bit different. So normally I'll go through my accounts and I can do that tomorrow. And so far we're having a really, really good month as we showed a couple days ago. Nothing has really significantly changed since then. Rolled a bunch of covered calls today. But what I want to get into tonight is I want to share with you how I'm trading long leaps here. And I'm mostly a premium seller. I mean, that's really what it's really what I do the most out there. I love selling, naked puts. I love selling strangles. I love the 112 trade. Those are my bread and butter trades out there. That's really what I see the most. And then, of course, selling some covered calls on leaps as well, or the poor man covered call, or even my version of the income poor man covered call, which a lot of people still struggle with. It's all good. We're not going to talk about that tonight. Anyway, what we are going to talk about tonight is I'm going to go into how I select leaps. Okay, so we're going to set the trading account over here somewhere. We're going to not talk about the trading account. We're going to talk about over here this investing account because I really think that you got to separate the two. If you don't do it physically, then you got to kind of do it mentally or on paper. Uh, but in a trading account, I'm all about generating the cash. All right, it's the income, it's the cash flow, it's 112 trades on a regular basis, it's naked puts, it's selling covered calls or income poor man covered calls on things. Those are the trades, strangles. I love those things. So that's all about generating cash and really increasing your cash flow. What I'm going to talk about today, though, is the investing account. And to me, it's a 70-30 split. So 70% of your money, again, it's age dependent a bit, but 70% of your money should be in investments. Okay. That's not trading. That's not the 112 trade. That's not strangles. That's not even really naked puts. Okay. It's your investing account. It's long-term investing. It's a little bit more of the buy and hold, if you will, but my twist on it is a little bit different than others. So I'm going to talk about that. But the other 30%, that's your trading account. That's much more risk. Okay. If you lose 10, 20, 30% at times and you go up 10, 20, or 30% at times, it's fine. Okay. Because we're all about the cash, right? And the income generation in that trading account. But in the investing account, we got to bring it down a bit. Okay. We don't want to get too carried away with getting too risky on things. Now, what I may share with you tonight, you may feel is risky as well, but I don't like to own stocks. I hate most stocks. Okay. If you've watched my videos for any length of time, you know I hate most stocks out there and stock companies. Okay. Not because there aren't really good companies out there. It's one wrong word, one missed earning, one poor guidance, one crazy something somewhere can rocket or tank a stock completely. Where indexes, to me, that's where it's at. They have upward drift. Okay, they have that positive drift. They're going up and up and up and up on the indexes. I love SPX. Okay, I love QQQ, SPY, what have you. Those are my favorites out there. Doesn't mean you can't do some stocks, and we're going to talk about some stocks tonight out there, but you got to have high quality stuff in your investing account. This is not where meme stocks, and I'm not even sure necessarily the wheel trades where I want to be because I don't really want to cap my income per se. I want things to run and I want to hold things long term. But I'm not interested in 10 to 11% returns that the S&P is giving me. So how do I improve that? And there's one answer to that, and it's leaps. Leaps are the greatest tool ever when it comes to capital appreciation. So I'm going to talk about how I do leaps tonight. I know it's a long intro. Stay with me. I'm going to share an exact trade plan, some examples with you, some scanners, lots of cool stuff today. But I'm going to give you an idea of how I'm trading leaps and what goes into at least my leap strategy when we're out there. So let's get into it. I'll try to shrink this down just a tad so it's not too big on your page, but let's just run through this a bit. right? So leaps, fantastic. Okay. Can be call or put options, typically expiration dates of 12 months or more. I mean, sometimes 9 to 16 months, depending on favorable. And to me, that's variable based upon the setup. Okay. If we've got a fantastic setup and we're all the way down to the 100 or 200 day moving average or an RSI on quality stocks somewhere in that 30, 35 range, then I think you go out maybe 2 years. If it's decent setup, but maybe not the greatest chart setup, but you're still like the 50 or the 21 EMA, then we may go a little shorter term, like 9 months or so. But I'm not talking about writing covered calls, none of that nonsense. Just talking about buying leaps and why I think buying leaps is absolutely the way to grow an investing account. All right. So why do we use them? Well, number one, when we go deep into money, they act like stock. Okay. They act like stock. They just use a lot less capital. So there's a huge bonus right there. They've got low theta decay, which gives you time for your thesis to play out, okay, over that time without you losing money, or at least a lot of it, at a given point in time. Okay, which is why we love selling options, but buying options, we got to be very careful that we don't let that theta eat away at our profits. Capital efficiency. Well, we can control the same exposure as stocks for about 15 to 20% of the stock cost, maybe 30%. And then flexibility, we can pair it with other strategies like covered calls and turn it into a poor man's covered call, or we can do the at the money, in the money extrinsic grab, as I call it, with the income poor man covered call. And then leverage and return on investment. I mean, this is where they shine. A 1% stock move is a 1% stock move, right? But using leaps, that same 1% can be more like a 3 to 4% move in a leap. Now, it does bite both ways. So if you have a poor stock or something that's not in really good shape and it starts to head south, well, a 2 or 3% return can now become something like a 9 to 10% drop using leaps. So it bites both ways in this great bull market that we've had this year and so forth. It's been a fantastic time to use leaps. In a bear market, may not be the best time to implement leaps. Okay, so it's all going to be really dependent for you. But let's get into how we crank out a stock list and then how we set up our trade. So let's get into this if you would. All right, so I like large cap stocks, and I'm looking for earnings and revenue growth of at least 10% year over year for at least the past couple years. Okay, and I like a return on equity of 15% or more. Okay, that tied with highly liquid options where we've got maybe a bid ask spread of around a half a cent or a half a dollar or so, 50 cents or so. I think that really sets things up pretty well, okay, for filters. So let's take a quick look, and I'm going to share filter with you right now. And let's look at, I know what, I'll get off the screen too, so maybe you can see the whole thing. All right, so let's look at a screener that I have. Same things I just talked about. Now, this Leaps screen is very different than my income poor man covered call screen. That screen is much more aggressive, and I like much more volatile types of assets that are really growing at a 20% return or more. But this is 10% earnings, okay, 10% revenue growth, 15% ROE, good size market cap, and I want an RSI under 50. And the lower the RSI, the better. In fact, uh, if we look at some of these stocks, you can see there's some pretty good names on here. And Amazon, it's starting to get down into that 30 RSI range, and it's not looking too bad. So we're going to use that as an example. Now, I also say, there's a lot of stocks down here, and you may like some of these, and Microsoft and Amazon and Meta and Lilly, which I don't really love for the strategy. Netflix and now ServiceNow, Shop is really starting to set up pretty well. And then on and on and on. If there's anything you see on here that you like, Adobe, any of the coin, any of those are decent. Now, what I like to do too is instead of just cranking out all the stocks out there, I will only trade what's in my watch list, which is a limited watch list. Okay. So I only really track, I don't know what, 2, 4, 6, 8, 10, 12 main stocks. Okay. I'll rarely trade outside of these, and then maybe another 15 stocks. Outside of that, I don't want to trade anything else. Okay. I'm a futures guy. I love my other types of trades, and I don't really love stocks. So if I'm going to do stocks, I want something that I think is a great company out there. So when I look at my watch list, well, it certainly gets narrowed down, but Microsoft, Amazon, Meta, Netflix, Shopcoin, all of those are great. If I sorted it by RSI here too, you can see Amazon right now is the best deal from an RSI standpoint. So we'll get into that. But if I looked at Amazon on the charts, and let's look at okay, Amazon here. Look at this selling that's happened in Amazon. It's just absolutely getting cooked over here. It is now down uh, almost 9% now in just 13 trading sessions. Okay. So 10% drop below its moving averages. It just broke the 100 today. Maybe it's ready to bounce. We'll see. It's very close to the 200 day. You don't get that opportunity to hit the 200 day very often. And when you do, get some decent bounces on there. I'm not saying today is the day, but I think we're getting doggone close on Amazon. So just keep that in mind. Let's get back to the overall scenario. Okay, so we've filtered out, we've found our stocks, we set up our list. Okay, let's get into the trade. I I want an upward multi-year trend. Well, Amazon has an upward multi-year trend. Okay, I would love to see some sort of a 5 to 10% market pullback. Well, we haven't had that yet. Maybe this is the start of it. Who knows? That would be ideal, not necessary, but ideal. A pullback to the 50 or 200 day moving averages. Well, we've blown past the 50. We just passed the 100 today, and we're closing in on the 200 day moving average. And I don't think there's anything wrong with Amazon. So lots of news out there, but I think those look good. RSI 30 to 50, and ideally, I mean, below 30, to me, that's almost once in a once in a decade type of stuff where that happens. And we've only been below 30, once in uh, like April of this year, once in August of last year, and then once in November of 2022. So again, it only happens every so often, and then we get some pretty good recovery. So I think it's starting to set up again as a really interesting opportunity. Okay. Also near the lower Bollinger Band. Well, today we're actually riding the lower end of the Bollinger Band. Now, when you're riding a Bollinger Band down, it can keep expanding, but we are past the Bollinger Band. Okay. Now we are going to be waiting on MACD to give us a little bit of a bullish crossover. That hasn't happened. So we might be just a tad early on it. But MACD, let's give it a day or two and see. We don't have to be the first one here. I don't want to catch the falling knife. I would just like to step over the bodies of the people that caught the falling knife because I don't need to be first. Okay. I don't need to be first to die on these things. I want to be first to win on these things. So let everybody else take the bullets, and then I will step in once that has calmed down a bit. And then IV rank here, I prefer it under 30, and Amazon is at 29 right now, so it is under 30. We just don't want to pay too much for the long lead. All right, let's get into trade entry rules quickly here. All right. I like expirations from 9 to 16 months, as I mentioned earlier. If you get these generational opportunities, these once in a couple year opportunities at the 200 or at RSI under 30, then maybe you go out a little further. Kind of what happened last April for us was a great opportunity to go get long a lot of things. right? I also like a strike, on my leaps between 75 and 85 delta. I really feel 80 is the sweet spot, but 75 is not the worst thing. If it saves you a decent amount of money, and you get pretty much the same amount, fine. 85, starting to stretch it a little bit. I'd rather stick between 75 and 80. Cost to stock price, typically I'm going to get a 25 to 40% discount. I'd like those bid-ask spreads a little bit tight, so I know that I'm getting a good deal and I have good liquidity. I don't really want to risk more than 5 to 10% of my portfolio on a trade, and I'm going to tell you 5% is probably more correct. 10% is a little bit much, and I don't really want to use more than 40 to 50% of my portfolio for leaps. In fact, I'd probably rather keep it closer to 30. You don't want to be too invested in leaps. But if it's SPY and QQQ, I'll probably push that 40% mark. If I'm going to do something like an Amazon or a Tesla or something else uh, out there, which again, Tesla doesn't fit the screen, but if that's what I was going to do for a leap, then I'd probably be a little bit lower. I think you have to be smart and understand what you're doing. And then I may start with a half a position and then scale later. So like right now, with the markets near all-time highs, maybe we'll start a little bit of a half a position. And even today on Amazon, with this pullback today on Amazon, tomorrow might be an opportunity for a half a position. And if it keeps falling, I can add another half a position later. Or if it starts to bounce more, I can still add another half a position and really have a pretty good entry area. And then how do I manage the trades? Well, I really do three things here on these. So I hope this is all helpful and making sense to you on it. But my profit targets, I'll typically take about half off once I hit about 80 to 100% gain, probably 100%. So if I can get a double out there, let's take it off. Let's take half off, and then I'll let the remaining half ride. I'll have taken my money, and then get all of my money out that I put in, and I'll let it ride. And then we'll look to finish the rest off at maybe 1.5 to 2x gains on that. That way I can rotate capital into other setups, maybe other stocks, other ETFs, and especially for me, I would like to roll my gains into SPY and QQQ, and potentially a couple, maybe even covered call ETFs or something to generate some income. All right, now that's what happens if things go well. What if they don't go well? Well, I will exit if the stock closes below major support, like the 200-day moving average. Okay, or if the leap loses half of its value, or if my thesis completely changes and I don't like the fundamentals or the story anymore on the company. Maybe Amazon would say something that I would absolutely not, be able to deal with, uh, and I want to get out. I don't know that that would be the case, but I certainly think that's something to consider. All right. Uh, so pretty easily to get out on these things. And again, size properly so that a 50% loss isn't going to decimate your portfolio. And then rolling rules here, I will roll up. Okay. If the stock rallies hard, a third of it, we make 20, 30%, 33% in a couple weeks. Great. And again, you can use leaps for more than just long-term investing. You can use them just again as replacement for stock. So maybe some stocks don't have good options uh, for shorter term trades, but you want to buy the stock, or maybe you just want to own the stock on something and get something, you just think it's got a good rip coming. So instead of spending a lot of theta to buy short term, in the money, out of the money calls or whatever, you just simply buy the in the money leaps. And if we get a 3% move in the stock, well, that's going to be like a 9 to 10% move in the leap. That's a pretty good deal. Okay, so you could swing trade with them as well. Uh, I also would roll back from 90 to 80 delta to reestablish my leverage. Okay, so I'm going to be looking at that. There's a lot more to this than what I'm sharing with you here, but if we get down to like a 90 delta, I'll probably roll it back to the 80 I'll book some of the gains that way. I can use the money, and I'm reestablishing leverage at a lower cost, which is going to now give me better leverage returns if we like what we see out there. And of course, when we get within 3 to 4 months left, I'm probably going to roll to either a new 12-month leap, or I'm simply going to close that trade and move on if it's a good trade. All right. And then that's really the key here. You could also uh, use these for poor man's covered calls, and I certainly recommend that you reinvest the profits as well and diversify across multiple assets. All right. So that being said, let's dive in and let's put on a little trade. Let's play around uh, in the uh, in the options trading here. So all right, let's get going. All right, so let's do Amazon, and we're going to go out a year. So here, let's go out to 358 days, pretty close to a year. Now, if I bought the stock on Amazon, it's at 218 right now. Okay, so you can buy the stock at 218, okay, which is going to cost you, okay, if I just bought this stock, okay, it's going to cost me 21,872, right? For the 218. However, instead of spending, and that's the cash that would be needed to take possession here. Your margin's less, and this is a PM account, so that's going to be much less. But we're going to focus on the cash needed to buy this right now at 21,000, right? If I wanted to buy the 80 delta, okay, well, that's only going to cost me, whoops, that's only going to cost me $67, okay, times 100, so 6,700. Right? So 6,700 to buy the 80 Delta Leap at 165. Right. So what does that do for us on this overall? So when we're looking, okay, here, it's going to limit our downside. So we can only lose what we paid. So when we bought the stock for 218, well, we could lose $21,800. Okay. So we could lose $22,000 buying the stock. If it goes to zero, I don't see that, but who knows? Yeah. But if we bought the leap here, we're limited to what we spent, which again is $6,700. That's the most we can lose as we go down here. And we would have to be in this for quite some time and have quite a big drop in order for us to even realize that. You can see with the T plus zero line here, you're only going to be losing about half of that maximum, even if we're falling substantially down here. All right, so back to the trade if we're going to get into this. And I'm not going to talk about synthetic longs, but the synthetic long might be an even better option. It's going to cost me 1,100 bucks, and this gives me a 1-to-1, one delta, but that's for another day and time. Let's spend some time right here. Now, if we paid 6,700 for this, remember, instead of 21,800, we spent 6,700. Okay, that's essentially one third, okay, give or take. So it's about one third of it, which means I have a three. I actually have a 3.3x leverage. Okay, so it doesn't mean go buy 3 contracts of this and now I'm back to the same risk profile and max loss that I had. No, don't overbuy and oversize. Okay, we can still control our 100 shares for 6,700, but here's the key. If the stock run, let's say Amazon goes up 10%, 10%, which means it's going to go from 218, it's going to go up $21. Okay, so 218 plus the $21, the 10% is going to take us to 239. Okay, so what do we make on that? Well, that's 10%. So 200, to go from 218 to 239, let's call that $21. I would make $2,100. Not bad. 2,100, 10% on the stock. Okay, maybe 2,200 if you want to, call it 22 and go to 240. But you get the point, right? So if it goes 10% up, that takes us to 240. and we make $2,200. Let's look at what the leap does over the same exact setup. We know that this is an 80 delta. Okay. So for an 80 delta leap, and I'm just leaving this on the screen because I don't have anything else to show you, but I'm going to go from 67, or from this 165 here that I paid 6,700 for. I'm going to go from that 65. I'm also going to go up 22. Okay. But $22, okay, when I only paid 67. Okay, but now I don't get it all because I'm 80 delta. So I will take the $22 move times the 80 delta, which means I'm going to actually go up $17.60. Okay, but 1760 based on the 6,700 that I have is a 26% return. So if Amazon goes up 10, these leaps are going to go up, okay, 80% because we have an 80 delta, 80% of the $22 or $17.60, 1760 divided by this 6,700 that we have here, okay, is $26 or 26%. Okay, pretty good. You're getting almost a 3x return on this thing. Okay, so 3x return. And if we go up $17.60, okay, we're going to make $1,760, but we only used 6,700. Okay, that's a pretty good deal, in my opinion. So that's how you can really scale using Leaps. Okay, out there. Is it, risk free? Absolutely not. Plenty of risk involved in leaps out there. I want you to at least think about it. I think, and don't go hog wild, but this is why I don't really trade stocks. If we are in a good, solid uptrend market, I want to be in leaps, not stocks. Okay, I want to make 3%, not 1% on every move. Okay, I would like to make 30% instead of 10%. And some of these stocks that have gone up 20 or 30% this year, I mean, you're talking 60 to 90% or gains or more in leaps. My hood leaps are up like 160% this year or something like that. So having a fantastic year in some of these simply because I went into leaps, and you don't have to scale all the way up and do, well, if only paying a third, I'll just do three times as many contracts. Don't do that. Okay. Keep it smart. Okay. Is a 3x return of whatever that stock's going to be, if that's not enough for you, okay, don't get too risky. Also understand that markets can go down just as fast as they go up at times, right? So you've got to find these high quality names. I showed you the scanner. I gave you a handful. I think Amazon might be setting up now. Either way, this is not financial advice. I'm just sharing what I do. This is how I trade. Okay. So do your own due diligence out there. I'm not a financial advisor. I'm not telling you what to do. I'm just showing you this is how I trade leaps. If you like this video and you got something out of it, give me a thumbs up down below. I gave a thumbs down to give me a thumbs up, but down below, give me the thumbs up down there. Go ahead and share this. If you're not a member, join. And if you want to see us trading live, you can join the Discord. There's no pressure here or there, but all these trades and trainings are much more detailed and much more live there. I love to be in a trading group. Okay, I learn, they learn, we all learn together. You've got a great mastermind. Okay, don't trade by yourself. Find a group of people with the same mindsets that you have that are hungry to grow and they have that growth-oriented mindset. And if you do that, you're going to be better off. I hope you got some value out of this video. I want you guys to have a great evening. Stay safe. Watch the markets. We'll see you tomorrow. Bye-bye.